Trump's One Big Beautiful Bill has officially passed, making this one of the largest tax cuts in US history. But what does this actually mean for retirees? In this video, I'll share how this bill has lowered tax rates, increased deductions, and created new incentives for those nearing or in retirement. And at the end, we'll talk about what's really going on with Social Security. Will it be taxed or not? Let's begin with the change that will affect nearly everybody listening to this, which is lower individual tax rates, specifically the 12, 22, and 24% rates. Now, these rates were initially going to expire at the end of 2025, but this bill now ensures that they're permanent and the highest tax rate will stay at 37%. So if you've been thinking about doing a Roth conversion or just simply being more strategic with your distributions from your retirement accounts, these lower rates provide additional time to plan without having to concern yourself with rates increasing in the future. Now let's move to the increase on the standard deduction, which in 2025, the standard deduction will be $15,750 for single filers or $31,500 for married couples filing jointly. So if you are married, the first $31,500 of income could be completely tax-free. This helps lower your taxable income across the board. And again, this is one of the changes made permanent by this new bill. This bill also includes an increase to the senior tax deduction for individuals 65 or older. Before this change, seniors could claim either a $2,000 deduction if you were a single filer or $3,200 if you were married filing jointly. But now there's an additional $6,000 deduction per qualifying individual on top of everything else. So if you're a married couple, 65 or older, here's how this stacks up. You get the standard deduction of $31,500 and the existing senior deduction of $3,200 plus the new bonus deduction of $12,000. That's a total of $46,700 in deductions, which means nearly $47,000 of income could be completely tax-free. And this is a big deal when you are trying to manage all the different types of income sources, such as required minimum distributions, Social Security, or even part-time income without jumping into a higher tax bracket. Now, there are a couple caveats though. This bonus senior deduction is temporary, as it only applies from 2025 to 2028. And it's subject to income phase-outs based on your filing status. But this bonus deduction creates a great short-term window for tax planning for those who are 65 and older. Now, all these extra deductions help, but it's just one part of the bigger picture. If you're trying to figure out whether you're on track for retirement, take the How Much to Retire quiz linked in the description below. Another temporary increase is the change to itemized deductions, specifically the SALT cap, which affects people who pay high state and local taxes. Previously, the SALT deduction was capped at $10,000 for the year, and this limited the benefit to taxpayers in high tax states like Hawaii, California, New York, and a few other places, because if you paid more than that amount, you couldn't take advantage of the SALT caps. But now that this bill raises the limit to $40,000 through 2025 to 2029, this makes itemizing deductions more significant for taxpayers burdened with higher property taxes, or those who generously contribute to charitable causes. This allows individuals who previously couldn't take advantage of this deduction and gives them much more of a reason to take advantage of all this, now that the limit has increased. Now, if you still have children at home or help support grandkids that you can claim as dependents, there's an upgrade to the child tax credit. This credit was originally scheduled to drop from $2,000 to $1,000 by the end of 2025. But since this bill has been altered, this not only prolongs its life, but it also increased the amount to $2,200 per child. Now, income phase-outs still remain, which is starting at $200,000 for single filers, or $400,000 for married filing jointly. So this won't apply to every retiree, but you can tell your own kids about this credit because it's worth keeping in mind if you or a loved one is still claiming dependents. Next is the update to the no tax on tips and overtime provisions. So if you work part-time in retirement, this is important to know. And despite what the headlines might say, overtime wages won't be completely tax-free. But this bill does offer a special deduction for them. You can now deduct up to $12,500 of overtime pay if you're single and up to $25,000 if you're married and filing jointly. Now, income limits do apply here as the deduction starts phasing out, starting at $150,000 for single filers or $300,000 for married couples. There's a comparable provision for tip income as well. This allows a deduction as much as $25,000, provided that you're in a business that customarily receives tips, such as personal care, transportation, or hospitality. Specialized professions that rely on the business owner's service or name, like doctors, lawyers, accountants, and unfortunately financial planners, you are not eligible for this provision. If you're retired but still working part-time as a consultant, freelancer, or maybe a small business owner, this following increase can save you a significant amount of money in taxes. And it's the new permanent change to the Qualified Business Income Deduction. This was introduced first in 2017, and it permits certain business owners and self-employed individuals to deduct 20% of their qualified business income from their taxable income. So for instance, if you earn $100,000 through self-employment or a small business, you could be eligible for a $20,000 tax deduction simply because you're self-employed. This is the case for most retirement age people who are working part-time as consultants, maybe operating a partnership or S Corp, selling products online, or even receiving 1099 income from jobs like driving or tutoring. Now, this deduction was set to expire at the end of the year, but not only does this new bill make it permanent law, but it also raises the qualifying income levels by a staggering $25,000 to $50,000 based on your filing status. So if you were previously phased out of this deduction, you may now discover that you qualify once again. And if you're launching a small business or side hustle in retirement, this is well worth looking into. The next update from this bill is towards an above-the-line charitable deduction. Previously, you only received a tax deduction for charitable contributions if you itemized your deductions. And because most Americans don't, they haven't received any tax benefit for their charitable contributions. But this bill changes that, which allows a $1,000 deduction for single filers and a $2,000 deduction for married couples. This means you can now get a tax benefit for your charitable contribution even if you claim the standard deduction. It's not huge, but it's a nice gesture for those who are charitably inclined or have a goal to give more in retirement. Another aspect of this bill, which won't affect everyone but is still valuable to certain families, is the raising of the state tax exemption. If legacy planning is important to you, this is going to be a big deal because now an individual can leave up to $15 million without being subject to federal state taxes. This also implies that a married couple can shield up to $30 million from a state tax under the current laws. Now, while most retired individuals will never get near this threshold, it can be a significant problem for farming families, families that own a lot of real estate, and small business owners who are maybe cash poor but asset rich. Estate taxes can force families to sell property or land to pay the estate taxes. But this provision provides them with the necessary leeway to plan carefully and maintain generational wealth. Last but not least, one of the new incentives outlined in this bill is the school voucher tax credit, which is a new tax credit of up to $1,700 for contributions to qualified organizations that grant school voucher scholarships. There is a catch here, though. Your state must choose to opt in. Therefore, this may not be relevant depending on your location. But if your state is involved and you're a fan of school choice, this credit provides a dollar-for-dollar credit towards your taxes when you contribute to these programs. Now, before we wrap up, I'd like to just take a moment to mention something that many retirees were hoping would be part of this bill, but wasn't. And that's the promise to make Social Security tax-free. Much was said about this, it hit the headlines. I even made a video about it, but in fact, nothing changed in regards to Social Security as it remains taxable based on your income. So depending how much adjusted gross income you receive on a yearly basis, Social Security could be tax-free, but but it also could mean up to 85% of your benefits could be taxable if you go over a certain income limit. So don't assume this bill eliminated Social Security taxes, because it didn't. This is why you need to consider forward-looking tax planning, particularly around RMDs, Roth conversions, and withdrawal strategies from your accounts. So for a deeper dive into how this all works, and in particular, surprise spike in taxes Social Security can trigger, I invite you to check out the video on the Social Security Tax Torpedo right here. Thanks for watching, and I'll see you in the next video.